Welcome back, guys, to another Zero DTE video, and today Coach Ernie is going to be talking about time decay, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description to find Coach Ernie's Skool Community. Enjoy, guys.
The time warp strategy is really designed for very low periods of volatility to make up for two things. One is the lack of change in price and the increase in the rate of decay of premium. So what you're trying to do is you're trying to go back and capture that extra premium that has already been decayed in a previous day or two, where it would normally have been delayed until the very last day. And you're also giving it a little bit more time to work out the price movement as well. So that is the purpose of the time warp strategy, the compensation for market conditions. So perhaps I could demonstrate what I'm talking about by looking at the rate of decay in a weekly option. So we're trading weekly options on indexes and some futures. They're not only weekly, but they are multi-day weekly. In other words, they can be anywhere from 3 to 5 days of expiration: Monday, Tuesday, Wednesday, Thursday, Friday. The SPX, the indexes, and the NDX, as well as the RUT, all have 5 days of weekly expiring options. The futures for the ES and the NQ, as well as the RTY, which is the futures for the RUT, but it has much lower liquidity, so we don't really trade it, also have 5 days. And then there are other commodities that have 5 days of expiration as well: the CL, or crude oil, and the GC, or gold, and they're worth looking at. It's interesting. Don't start searching around for something to trade. Stick with the standard first, get good at that, then expand. But we choose them based on their size and their relative amount of volatility from one another, because each of these different indexes and commodities that have different levels of volatility. So for instance, when we're finding that a big ass fly isn't working on the ES, we might check the NQ or the NDX and see whether or not there's sufficient volatility in there to make that trade viable. Because on average, there's about 10% more volatility in the NASDAQ. This is looking at a single option and the rate of premium decay. Now, I'm sure all of you know that there are two components to the value of an option. There's intrinsic value and extrinsic value. There's no requirement that you have intrinsic value, but there is always extrinsic value. The extrinsic value is the time value. Only about 10%, maybe a little bit more than 10% of all options will expire with some intrinsic value. In other words, another way to say that is 90% of all options will expire worthless. All right. So that's an important point. Of course, the intrinsic value happens when the market price exceeds or passes through the strike price of your call or put option. And however far it passes through it, that will determine how much intrinsic value you have. That only happens 10% of the time. Think about that. So all of you people that are so hot on long options, all the odds are against you for a long option. Your odds are 1 in 10 that you're going to end up in the money. It's not a great game to play. Now, time value is different. Time value is the value that the market gives to an option based on how much time is left in that contract. And the idea is, the more time that's available, the greater the opportunity or probability that it could achieve intrinsic value or some value. As we approach expiration, that opportunity starts decaying, and rather fast, especially on that last day. That's why we trade the very last day of expiration, because we are collectors of that decaying premium. Now, there is this view that I have here is showing a weekly option, and the vertical columns are each day in the life of that option. And the magenta line, that curved line that looks like an exponential decaying line, is the extrinsic value or time value over that period of time, the 8 days the option is alive. Now, this is a very normalized view. In other words, it's average. This would be the idealistic view if there was no volatility. But we do know that there is volatility, and volatility has a direct effect on the rate of that decay. So volatility can either delay or increase that rate of decay. And so we have essentially two polar opposites of volatility. We have high volatility and we have low volatility. High volatility has the effect of delaying that premium decay. And the reason for that, in other words, high volatility will delay it so that there's more, or the premium decay gets all backed up until further and later into the life of that option, thereby inflating the value of that option. And so the decay curve will look something like this in high volatility. And the reason why it does that is that with high volatility comes greater range in price movement. With greater range in price movement, there is a higher probability that the option will achieve intrinsic value. So therefore its value, its speculative value, is inflated. And another way to say it is that the decay of the premium of that option is delayed. And so that's what this delay looks like. So if you look at the very last day, the 0 DTE day, you can see clearly that by imposition of high volatility and inflating option, or decaying or delaying the decay, is that on that last day, there's way more premium available than there is on a average day or a normalized view. On days where there's very low volatility, or even in volatility regimes, that rate of decay is rapidly increased. And so that sucks all the life out of an option, or sucks all the extrinsic value out of an option. And the reason for that is that in low volatility, we have a much smaller range of price movement. And that much smaller range of price movement is essentially taking away the probability, or diminishing the probability, that option is going to achieve that intrinsic value. And so therefore, the rate of decay is increased. So it looks like this. And in that case, on that last day, there's very little premium left. If you look very closely, you'll see that both of the rate of decays, I have them stopping at a certain point in time that is not at the end. This period of time is approximately somewhere between, I don't know, 1:30 and 2:30 in the afternoon, Eastern time. After that time, volatility has no effect on that option, or so little that you cannot perceive it. After that time, right in that range somewhere, the final arbiter to the decay of that premium is time. That becomes the final arbiter, time. And this is primarily the reason in the first part of the day, on that 0 DTE day, is where you find the most volatility. And then as you get in, or outside of the morning session and into the afternoon session, that volatility starts dropping off dramatically. It will rise a little bit at about 3 o'clock, but not enough to really affect the decay rate of premium. So it's of no real use to us that volatility increases during the power hour. A lot of people will tell you otherwise, but they're lying. It's not true. Doesn't really affect us, doesn't help us. So we are not really concerned about later day volatility. All we're really concerned is late morning volatility. And that is why we place our trades then, because that will give us the best possible risk to reward and lowest gamma in that day for putting on a butterfly or any options trade.
Thanks for watching, guys. I hope you enjoyed the video, and if you did, make sure you hit the subscribe button and the like button below. If you're interested in becoming a pro trader, remember to check out the link in the description for Ernie's Skool Community.